A lot of people think buying stocks when they're falling is the smart move. Catch them on sale, wait for the bottom, then load up. But here's what actually happens to most people who try this. The stock drops, and you freeze. You don't know if it'll keep falling. Down Fei, you wait down Fei, you're scared. Down Fei, you can barely bring yourself to look at it. Then it starts bouncing back up Fei. You think it'll dip again. Up Fei, you're getting anxious. Up Fei, you can't take it anymore. You buy in. And then almost like clockwork, it starts falling again the day after you pull the trigger. That is not bad luck. That is just what human psychology does in markets. Fear freezes you when you should be thinking clearly. Anxiety pushes you to act when you have no real reason to. Real experts don't just buy dips, they buy when they have a clear, specific reason to buy. Price movement is the outcome, it is not the reason. Here are 9 rules serious investors live by. None of them are complicated. In fact, you'll probably read them and think, yeah, I already know that. But the number of people who actually stick to them long term is much smaller than you'd expect. The hard part isn't understanding them, the hard part is doing them. A lot of people think the more stocks they own, the safer they are. Diversification, right? So they buy sometimes different stocks. But here is the reality. Can you actually follow companies at the same time? Their news, earnings reports, industry shifts, you have a job, a family, a life. You don't have the bandwidth to truly understand what is happening with different businesses. What ends up happening is you own stocks and genuinely have no idea why of them are moving. You just bought them and forgot about them. That is not diversification. That is giving up on management entirely. There is another problem. Too many positions dilutes your returns. Say you have spread across stocks. One of them goes up in a day. Great news, right? But because that position is only of your portfolio, a gain only moves your total account by You did the research, made the call, tracked it, and the impact on your actual wealth was That is not efficient. Start with stocks. Once you've gotten comfortable, once you can read the numbers with more confidence, maybe scale up to Beyond that, it is easy to go past what you can actually manage. Concentration is what creates meaningful returns. Spreading too thin doesn't make you safer. It just makes you feel safer while you lose control of everything. Someone will inevitably ask, what if all go down? Then cut your losses and rotate. You're always managing positions, but not necessarily the same forever. The point isn't to hold on to any specific stock forever. The point is that at any given moment, you only own what you can actually manage. For every trade you make, record these 4 things. Why did I buy this stock? Write it down. What price will I sell at if it goes against me? Decide before you buy. And write it down. What caused the price to move while I held it? Just a line or 2. Why did I sell? Write it down. That is it. 1 or 2 sentences for each. Don't write an essay. If it takes too long, you'll stop doing it. This only works if you keep it up. Here is what that looks like in practice. Semiconductor export data showed clear improvement, so I bought XYZ chip stock. Stop loss set at below entry price. Stock dropped today, likely a reaction to tariff news, but the core thesis is still intact. Watching closely. Sold at stop loss. Industry trends shifted and customers started cutting orders. Simple, like keeping a trading diary. Why does this matter? Because a journal is one of the only tools that actually makes you better over time. In chess, the most important thing isn't making every right move. It is reviewing the game afterward to see where you went wrong and why. Investing is the same. No record keeping means no review. No review means you keep making the same mistakes. And there is a hidden bonus if you have to write down why you're buying something before you buy it, and you can't come up with a real answer, that is your signal not to buy. The first hour of trading is the most emotionally charged part of the day. When the market opens strong, everyone rushes in. Buy now before it is too late. When it opens weak, everyone panics. Sell before it gets worse. A lot of the volume you see in that first hour is emotion, driven, not reason, driven. Your chances of getting swept up in it are high. Same goes for the last few minutes before close. Volatility often spikes again. The calmer window for decision making tends to be mid-session, somewhere around an hour after open through midday. The emotional storm has passed, and you're more likely to be thinking clearly. Some people get obsessed with the best time to trade. Is Fei better than Fei? That line of thinking doesn't lead anywhere. Investing isn't fortune telling. When you buy matters far less than what you buy and why you're buying it. You can place an order at any time of day. Spend your energy on the right stock and the right reasoning, not on finding a magic minute. This is one of the most dangerous misconceptions out there. A lot of people think long-term investing means you buy a stock and never sell, no matter how far it falls. Down Fei, I'm a long-term investor. Down Fei, still holding. Down Fei. Finally, they admit they might have been wrong. That is not long-term investing, that is long-term suffering. Real long-term investing means staying in the market for a long time, not clinging to one specific stock indefinitely. Those are two completely different things. What does it take to stay in the market long-term? You can't let a single bad call wipe you out. One catastrophic loss can force you off the field entirely. Your capital gets cut in half, your confidence collapses, the people in your life start losing patience, and you're done. So for anyone picking individual stocks, the first requirement of long-term investing is knowing your exit before you enter. If the stock hits your stop loss, or if the original reason you bought it no longer holds, you sell, no hesitation, no excuses. No, let me just wait a little longer. People hear stop loss and think it means short-term trading. It doesn't. A stop loss is what lets you stay in the game. If you cut a position that is down Fei, you still have Fei of your capital. You can redeploy it toward a better opportunity, but if you don't cut it, that Fei becomes Fei. Now you need a Fei gain just to get back to even, and that could take years. You've heard plenty of success stories about someone who bought a stock and held it for Fei years while it went up Fei's. What you haven't heard are the stories of people who held a stock for Fei years and lost Fei. Those people don't go on podcasts. They disappear quietly. You're only seeing the survivors. Don't let survivorship bias fool you. Don't ask how much money do I have to invest? Ask, how much am I okay losing? If you could lose Fei and still sleep fine, still live normally, still make clear-headed decisions, then you're in a position to invest Fei, because a Fei stop loss equals Fei. If you can only stomach losing Fei, your investment should be around Fei. Let your loss tolerance set your position size, not your account balance. This approach has a powerful effect on your mindset. When you've already mentally accepted the worst-case loss before you start, a Fei dip doesn't shake you. You know you're still well above your stop. You can think clearly about whether to add weight or exit, because your original thesis changed. But if you've put in everything you have, a Fei drop might cost you a month of living expenses, and decisions made in fear look nothing like rational decisions. FEX ETFs, futures, options. These tools all share one characteristic: they amplify volatility. More volatility sounds symmetric. Win more, lose more, fair trade. It is not fair. The math of losses is more damaging than the math of gains. Leverage a Fei drop in the underlying into a Fei loss on your position. And in choppy, back and forth markets, leveraged ETFs lose value through daily resets and volatility drag in ways that make recovering the principal far harder than you'd expect. A few big swings can eat a significant chunk of your capital, even if the underlying eventually recovers. Beyond the math, leverage is psychologically dangerous. The dopamine hit when leveraged trades go right is intense. You'll want to trade more. Higher frequency means more transaction costs and slippage, which slowly erode returns. You stop being an investor and start being a gambler who thinks they're an investor. Some trading apps make this worse. Big colorful buttons, one-click buy on today's top movers, the whole thing designed to feel like a game. That is not helping you invest. It is lowering the friction on impulsive decisions. Real investing should be boring. If investing feels thrilling, you're probably taking on too much risk. As for futures, that is a professional tool. Sophisticated traders use it primarily for hedging or with strict risk management frameworks, not for riding adrenaline on directional bets. Maintaining that kind of discipline as a regular person with a day job is extremely difficult. Don't touch it. I only have Fei or Fei. What is the point? Even if I double it, it is still not much. I'll wait until I have Fei. This thinking is wrong, dangerously wrong. Fei invested at Fei annually grows to around Fei in Fei years. Add Fei every year, and you might be looking at something approaching Fei million. The math doesn't require genius. It doesn't require catching the next big stock. It requires time, discipline, and not being forced out of the market in the middle. Small amounts have a huge underrated advantage. You can afford to lose it. And when you can afford to lose it, you don't panic. When you don't panic, you make better decisions. Better decisions keep you in the market longer. Staying in the market longer is what lets compounding actually work. The opposite scenario is also real. You spend years saving up Fei, you put it all in at once, and the market drops Fei in the first month. Fei gone. You panic, sell, lock in the loss, and walk away bruised. Big starting amounts can actually make it harder to stay the course, not easier. Don't wait. Start with Fei, 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 Fei. The amount matters less than the act of starting. If you're starting out with, say, Fei, Fei, consider splitting it into 3 buckets, Fei in a large cap index ETF. Something that tracks the biggest, most established companies. This is your anchor. It won't make you rich overnight, but it keeps you aligned with the overall market's performance. Fei in a mid-cap ETF. Mid-sized companies tend to be more volatile, but they can offer growth that the large-cap index doesn't always capture. A little more upside potential with a little more movement. Fei in one individual stock you've researched and believe in. Not 2, 1. Why only 1? Because you need to be able to review your decisions. If you buy 2 stocks and one goes up while the other goes down, what did you learn? Nothing. You can't evaluate whether your reasoning was right or wrong, but if you pick one stock, you can analyze it clearly. When it goes up, you can examine why your thesis held. When it goes down, you can figure out exactly where your thinking was off. You have a clean comparison against the stocks you didn't pick. Think of it like chess. Every move teaches you something, but only if you review it afterward. Playing 2 moves at once teaches you nothing. Investing isn't a one-time event, it is a lifelong practice. Early on, what you learn is worth more than what you earn. Force yourself to make choices. Force yourself to live with the consequences of those choices. That is how you actually grow. High dividend stocks are attractive, especially for people close to or in retirement. The idea of collecting steady cash every year sounds safe and stable, but high yield doesn't mean low risk. Sometimes, a stock has a high dividend yield simply because its price has dropped, not because the company is in great shape. You think you're collecting stable income. Meanwhile, your principal might be quietly shrinking. The dividends you're receiving might not even cover the loss in value. And truly reliable high dividend payers are rarer than people think. A company that pays generously this year might cut its dividend next year. What feels like predictable cash flow is still full of uncertainty. If you're retired and thinking about risk management, the more powerful move is simply to reduce the total amount you have invested, not to hunt for a safer looking stock. If you have Fei in retirement savings, don't throw all of it into high dividend stocks. Put Fei into a broad index ETF and keep the rest somewhere liquid and low. Risk controlling your exposure is more effective than picking the right label. Investing is your responsibility, but it is also one of the best things you can do for yourself. You don't have to learn everything at once. Start with Fei stocks. Write down Fei things per trade. Skip the first hour of trading. Set your stop loss before you enter. Know the difference between staying in the market and holding a specific stock forever. Work backward from what you can lose. Start now, even if the amount feels small. None of this is hard to understand. All of it is hard to do consistently, but like any skill, it gets easier with practice. Eventually, it becomes habit, and once it is habit, it stops feeling hard at all. The biggest investment risk isn't losing money, it is never starting. Inflation quietly erodes the purchasing power of cash over decades in ways you don't see day to day. 30 years from now, you'll be glad you started today,